As investors, we all want our money to grow as much as possible. It's only natural. The problem is, most people go about trying this the complete wrong way. They're always looking for an edge. They're always looking for ways to outperform their market on their way to investment success. Thankfully, there is a better way. And what I'm going to show you in today's video is what you need to know to create the best possible investment experience and to maximize your chances of building wealth over time. I'm James Canole, founder of Root Financial Partners, and I'm here to show you how you can create a secure retirement. The markets are incredible and the markets are terrible all at the same time. And if you've tried at all to beat the market or to outperform the market over time, you've likely seen how challenging that can be. Now, the key to understanding why this is the case is also the key to understanding how you can perform the best over time. Because when you look at the stock market, think of it almost as like the greatest information processing machine of all time. What you get with the stock market is you get a whole bunch of people around the world. People who have expectations about where the GDP of different countries is going to be. People with expectations about inflation. People with expectations about growth for companies or sectors or what debt levels are going to do or what unemployment numbers are going to do. And you have all this information all around the world. And what's happening is, based upon 2020 numbers, over $650 billion of stocks and securities are traded on a daily basis. What does that mean? It means all those expectations about information we know and things we expect to happen, that immediately becomes reflected into the price of the stocks that we're buying. So when you're thinking about investing, if you're trying to outperform the market, or if you think that you're going to get an edge by buying a stock, you have to ask yourself, what do I know about this company that's not already reflected in the price of this security? What does this mean in practical terms? Well, what it means is it's extremely difficult to outperform the market. Outperforming the market means that we have somehow gotten an edge over the market, which on a daily basis or monthly basis or even yearly basis isn't difficult to do. In fact, sometimes it's just pure chance that we have something that outperforms the market. But over time, if you look at the most well-compensated, the most intelligent, the most well-educated, the people with the most access to information, you want to look at Wall Street. And over the past 20 years on Wall Street, those returns compared to the unmanaged index or the market as a whole should tell us something about how difficult it is to beat the market. If we look at the past 20 years, fewer than 19% of all US stock mutual funds actually outperformed the market being the S&P 500. Over that same time frame, over the past 20 years, only 11% of fixed income, so aka bond funds, outperformed the bond index. Now, it's not because these aren't intelligent people. It's not because these people don't know what they're doing. What's causing this is it is just so hard to outperform the market. So if the best, the brightest, the most well-educated cannot beat the market consistently, what chance do most individuals have? The answer is very little. Well, we look at that, and that points to bad news, right? Oh gosh, if I can't beat the market, what chance do I have of meeting my retirement goals? What chance do I have of accomplishing the things that I want to do? Well, this actually isn't a bad thing. I want to reframe this actually, because this environment of $650 billion trading hands every day, and what that effectively does is it leads to a fair price. When you have that many people trying to beat the market, incorporating all this different information about what we know and what we expect to happen, what you tend to get is almost like an equilibrium price when you're buying a stock. That benefits everyday investors. Because when you look at this, what you know when you're buying a stock is you're probably not buying something at a terrible discount, but you're probably also not getting ripped off for it. Because whatever the price of that stock is, or that bond is, or that security is, it's reflecting all known information and expectations about that stock. So it creates a fair playing field. So as investors, what that means for us is that we don't necessarily have to beat the market. We just need to capture market growth. So it's a reframing here. Instead of trying to work against the market and work against all these people all around the world making trades based upon their needs, their preferences, their expectations, if we can simply harness the power of the market, we're going to set ourselves up for tremendous success. I live in San Diego, and in San Diego we have some amazing beaches. On those beaches, one of the things I love to do is surf. And now an analogy I like to use is when you're surfing, or just if you're at the beach at all, when waves are breaking, if they're breaking close to the shore, that water needs some way to get back out into the ocean. So as waves are breaking on the shore, oftentimes what's formed is a rip current. And that rip current is where the water creates a narrow stream back out into the ocean. So waves break in and the rip current brings people back out, or brings the water back out. Now, rip currents, if you try to work against them, they can be incredibly dangerous. You're gonna lose at best, and at worst, they can actually be deadly. If you work against rip current, you're working against the force of this massive, powerful ocean, and it's a battle you're not gonna win. I like to think of investing the same way, because as a surfer, if I'm trying to paddle out and if I want to go surfing, I don't want to battle against the waves. I don't want to go duck dive and paddle and swim and hold my breath and take a long time to get out. If there's a rip current that happens to be there, I want to work with it. I'm going to go find the rip current. I'm going to intentionally paddle into it, allow that to take me out, and then I'm going to paddle perpendicular to the shore, parallel to the shore, to get to where I need to go so that I can surf. As investors, it's the same principle. We can try to work against the market. We can try to work against this crazy force of the market with all this information and all these trades and all this stuff happening, but you're probably going to lose and you're probably going to be exhausted when it's all said and done. If instead of working against the market, you work with the market, that can create a tremendous amount of wealth for you. Now, before you go off and say, okay, I should just go buy an index fund, I should just buy the S&P 500 index fund, that's not exactly what I'm saying. That's a good place to start, but there's so much more to it than just that. So let's walk through how working with the market can generate tremendous amounts of wealth for you. If you look at different market indices, what you'll see is the global stock market is not just one thing. There is no just global stock market. All you have is a whole bunch of individual companies you can invest in. So if I want to buy stock in Apple, I buy stock in Apple. If I want to buy stock in Ford, I go buy stock in Ford. If I want to buy stock in Nike, I go buy stock in Nike. And all you have is a whole bunch of individual companies that you can invest in. So the global stock market is just a way of saying, look at all the different individual companies you can invest in. Now, when people are talking about the S&P 500, what that's a reflection of isn't the whole market, it's just about the biggest 500 companies here in the United States. Now, if you go back to 1926, had you invested one single dollar into the S&P 500, that would have returned about 10.3% from 1926 until the end of 2020. So that's a pretty significant return. 10.3% is great. How does that translate in dollar terms? Well, $1 invested in 1926 would have been worth $10,937 by the end of 2020. That's wonderful. Now, if you don't just look at the S&P 500, but you look at other aspects of the market, well, if instead of investing in just the S&P 500, if you had invested in a large cap value index starting in 1928, that would have returned 11% per year over the next several years and decades. Now, $1 growing at 11% per year would have grown to $17,022 by the end of 2020. Now, what if instead of investing in big companies, you invested in small companies? So the S&P 500 is a measurement of big companies. The Russell 2000 is an index that tracks things more like small companies. And if you look at a small cap index or small company index since 1928, it's performed 11.9% per year over that time period. Meaning $1 invested there isn't the $10,900 that it would have been had it been invested in the S&P 500. It's $36,153 had you invested it in small companies instead. Now, what if you didn't just do small companies or just do value companies like we saw maybe perform better than the S&P? What if you did a combination? What if you did small value companies? Well, that would have returned 13.1% since 1928. And $1 invested in a small cap value index over that time would have grown to $92,668 by the end of 2020. So as I'm looking at this, I want to paint the picture here. You could try to work against this. You could try to work against these different indices and all the information processing power of the stock market. Or you could work with it. You could view these as different rip currents that are trying to take you to your goal. And instead of working against them, can you align yourself with the right markets? Can you allocate your capital in such a way as to maximize your growth potential over time? Here's the good news. This doesn't take superior knowledge. This doesn't take an incredibly active trading strategy. This doesn't take a whole lot other than having the right perspective, knowing where to invest, and then having the patience and discipline to wait it out over time. Now, you may not have this time horizon that I'm talking about here. These numbers are from 1926 and 1928. You might look at that and say, James, that's great, and if I had 95 years, I'd do the same thing. Most of us don't, but the principles apply. So what's more important than beating the market? There's 4 things, and the 4 takeaways I want you to get from this illustration. Number 1, allocating your money, your capital, your resources to the right parts of the market is more important than beating the market. Again, the S&P 500 is not the market. It has some wonderful companies, some of the best companies in the world, but it only represents about 500 of thousands of companies around the world. So as you are creating an investment plan, are you allocating your money to the right places that will maximize your chances for success over time? Number 2, create a financial plan to understand what your money can do for you. Without a plan, we really have no benchmark for success. And our only benchmark for success becomes, what's the Dow Jones doing, or what's the S&P 500 doing? Well, if that's the case, you're really lost, because it's possible that you could outperform the S&P 500 every single year and still miss all of your financial goals. It's possible you could crush the Dow Jones Industrial Average every single year and still not be able to retire comfortably. So instead of benchmarking success to some index, benchmark your success to your plan. What type of performance do you need? What type of growth do you need? What type of experience do you need from your investments in order to create the income and fulfill the goals that you have with your financial plan? Number 3, create an investment plan that fits your needs and your capacity for uncertainty. What I mean by that is it's not all about maximizing growth. Maximizing growth is fun, but with that growth comes uncertainty and risk. Understand this. So as part of your investment plan, know how much you need. That isn't designed to maximize growth or outperform over time, but that's designed to create security or liquidity or access to funds as they may be needed. You do this for 2 reasons. Number 1 is because your plan calls for it. Maybe you need some cash on hand in case there's a market downturn or for a big upcoming purchase. Or maybe having more conservative investments allows you to sleep better at night. It fits better with your personal comfort level with uncertainty. But make sure your investment plan is in alignment with your financial plan to ensure that your portfolio is driving in the right direction that will help your financial plan be realized, as opposed to just some arbitrary benchmark that it's compared to. And then number 4, manage your emotions by staying disciplined. So often when people talk about being wiped out in the stock market or losing money in the stock market, sometimes it's because they weren't diversified and they picked a bad stock and things went south. More often than not though, it's because their emotions got in the way. I've talked to so many people who pulled out in 2008, or who pulled out in 2016, or who pulled out in 2020, or who pulled out different times along the way because of fears or concerns about what was going on. Well, what's happened is they've stayed in cash and the markets continue to advance. There will always be bad news. There will always be negativity in the headlines. But if you have a financial plan, and if you have an investment plan that's allocated in a way to support your financial plan, you need to maintain discipline, tune out a lot of the noise, and make sure you're taking the right steps with your portfolio. Thanks for watching. I'm James Knoll with Root Financial Partners. If you found value in this video, please be sure to share it with others who you think could also benefit from it. And please also make sure that you give a thumbs up and like this video, and subscribe if you haven't done so already. If you want more resources about how you can create your secure retirement, be sure to tune into our podcast, Ready for Retirement. And if you want more information about the services we offer to help clients with these types of things, be sure to visit our website at rootfinancialpartners.com.